Okay, so you want to buy a private jet charter company. Rich clients, sleek jets on the tarmac, a phone that rings every time a billionaire needs to be somewhere in 4 hours. Sounds like the cleanest luxury business on earth. Here's the strange part. The single most famous investor to ever own a piece of this industry is Warren Buffett. He bought in for $725 million in 1998, and by his own admission, the company lost money for the next 11 straight years. Not a bad quarter. 11 years. Meanwhile, one of the most recognizable brands in private aviation, a company flying celebrities and CEOs, doing close to $1.2 billion a year in revenue, saw its value collapse from $2 billion to $100 million in about 18 months. This is an industry that sells $10,000 an hour luxury to some of the richest people alive, and somehow keeps almost going bankrupt anyway. By the end of this video, you'll know exactly why that happens, how the money actually moves through this business, and why the door you walk in through matters more than almost anything else you'll decide. There are 4 doors into this industry, and each one is a completely different business wearing the same jacket. The first and cheapest is the charter broker. You don't own a single aircraft. You take a client's request, find an operator with an available jet, and take a commission, usually somewhere around 10 to 15%. Startup cost, maybe $50,000 to $150,000 for an office, insurance, and a booking system. It's the only door that doesn't require you to touch an actual airplane. The second door is becoming a Part 135 operator. That's the FAA certificate that legally allows you to fly paying passengers for hire. This is the mom and pop version of this business. 1 or 2 jets, your own certificate, your own cruise. The third door is fractional ownership, the model Richard Santulli invented in 1986 and later sold to Buffett. You sell slices of a shared fleet, a 1/16th of a jet at a time. This door needs real scale to work. You're essentially running an airline disguised as a timeshare. And the fourth door is the membership or on-demand model, where clients pay a deposit for guaranteed access to a managed fleet without owning any of it. This is the most capital-hungry door of all, and it's the one that nearly destroyed the company we're about to talk about. Let's say you walk through door 2, because that's where almost everyone actually starts. First, the certificate itself. Getting FAA Part 135 authorization is not a form you fill out. It typically takes 12 to 18 months and can run anywhere from $150,000 to over $500,000 in legal, consulting, and compliance costs before you've flown a single passenger. Then, the aircraft. A used light jet runs $3 to $5 million. A mid-sized jet, the kind most charter clients actually want, runs $8 to $16 million. Step up to a heavy long-range cabin and you're at $30 to $45 million. And if you want the top of the market, something like a Bombardier Global 7500, you're writing a check for around $75 million. Brand new. Here's what nobody mentions when they picture this business. Every aircraft needs a minimum of 2 pilots, and you don't just hire them, you train them onto that specific aircraft type, which runs $20,000 to $40,000 per pilot. Combined pilot compensation for one aircraft typically lands somewhere between $150,000 and $250,000 a year before benefits. Insurance, hull, and liability combined runs $50,000 to $150,000 annually per aircraft and climbs fast for anything larger. And then there's the cost nobody budgets for correctly, the maintenance reserve. Every flight hour, you're required to set aside money for the eventual engine overhaul, typically $250 to $900+ per hour, depending on the aircraft, whether you use that hour or not. Add hangar space, scheduling software, and recurrent training, and a single mid-sized jet can cost $1.5 to $2.5 million a year just to exist, before it earns you a single dollar. So how does the money actually come in? 2 ways. The first is simple, the hourly charter rate. A light jet charters for roughly $3,000 to $4,500 an hour, a mid-sized jet $4,500 to $7,500, and a heavy long-range cabin can run $7,500 to $15,000 an hour or more. The second way is where this industry gets clever and a little dangerous, the prepaid deposit. Jet card programs and membership models get clients to pay tens or hundreds of thousands of dollars up front for guaranteed future flight hours. On paper, that's beautiful. It's free cash sitting in your account before you've burned a drop of fuel. In practice, it's a loan from your customers that you're required to repay in airplane seats. And if the company ever runs into trouble, that prepaid money doesn't disappear. It just becomes a liability owed to thousands of people who thought they were buying flights, not investing in your balance sheet. That exact mechanism is what nearly ended Wheels Up. Kenny Dichter founded the company in 2013, built it into the second largest private aviation provider in the country through a string of acquisitions, and took it public in 2021 through a SPAC merger, riding a boom year for private aviation. Revenue hit close to $1.2 billion. The stock opened around $10 a share. Then, the arithmetic caught up with the ambition. By May 2023, Wheels Up had posted a $101 million loss in a single quarter, $12 million worse than the year before. Its stock had collapsed to around 40 cents, and its total valuation had fallen from $2 billion to roughly $100 million. Dichter resigned as CEO that same week. And here's the detail that should worry anyone thinking about this business. At that moment, Wheels Up was holding more than $1 billion in prepaid member funds, money from over 10,000 customers who had paid in advance for flights that hadn't happened yet, sitting as unsecured claims against a company that consultants were openly telling reporters might file for bankruptcy. Delta Airlines, which already owned 20% of the company from an earlier deal, stepped in with a $500 million rescue package in August 2023, taking a controlling stake and triggering a 1-for-10 reverse stock split just to keep the shares on the New York Stock Exchange. The brand survived. The people who founded it and rode the SPAC high did not. Now compare that to NetJets, sitting on the other end of the same industry. Buffett bought it in 1998 for $725 million. Kept it running through 11 years of losses that he later admitted publicly he hadn't fully anticipated, and stuck with it anyway because Berkshire Hathaway could absorb over a decade of red ink that would have killed almost any other owner. Today, NetJets is estimated to generate somewhere between $6 and $8 billion a year in revenue, flies roughly 1,400 flights a day, and counts over 40% of the Fortune 100 as clients. Same industry, same brutal cost structure, completely different outcome. And the difference wasn't the business model. It was who was standing behind it when the losses came due. That's really the entire pattern behind why this industry eats so many of the people who enter it. Mistake 1, growing the fleet faster than the balance sheet can absorb it. Wheels Up didn't just buy planes. It bought entire companies: Delta Private Jets, Gamma Aviation Signature, Mountain Aviation, stacking integration costs, mismatched fleets, and duplicate overhead on top of an already thin margin business. Mistake 2, treating prepaid customer deposits as working capital instead of a liability. It feels like revenue the day it lands in your account. It behaves like debt the day growth slows down, and you can't fly your way out of the obligation fast enough. And mistake 3, the quiet one. Fixed costs in this business, pilots, hangars, insurance, maintenance reserves, don't care what the economy is doing. Revenue does. The moment a recession makes a CEO's board start asking why he's still flying private, the costs stay exactly the same and the income doesn't. So let's put real numbers on this. Optimistic scenario. You run 2 mid-sized jets under your own Part 135 certificate, both well utilized on a mix of charter and membership contracts. Combined annual operating cost, including crew, insurance, maintenance reserves, and hangar space, runs around $3.5 million. If you're keeping both aircraft flying roughly 700 hours a year, each at an average charter rate of $6,000 an hour, that's $8.4 million in gross revenue. After fuel, positioning costs, and overhead on top of the fixed costs above, you're looking at a net profit in the range of $700,000 to $900,000 a year. Respectable. For 2 airplanes. Realistic scenario. 1 aircraft needs an unscheduled engine event mid-year, taking it out of service for 6 weeks while it still accrues insurance and financing costs. Your utilization drops to 550 hours per aircraft instead of 700. Slow economic quarter pushes your average realized rate down to $5,200 an hour after discounting to keep clients loyal. Run those same numbers again, and your $700,000 profit year turns into a $150,000 loss year on the exact same 2 airplanes, with the exact same clients in the exact same market. That gap between a very good year and a bad one is the entire private aviation industry in miniature. So, if you still want to buy a private jet charter company, just remember what Buffett learned the expensive way. In this business, the plane isn't the asset. The balance sheet behind it is. Make sure yours can survive 11 bad years, because in private aviation, the good ones don't always come first.